Mike, what do you think's going on here?
Listen, this reminds me a lot of 2018 December when the Fed had this idea of one last hike. And of course, it sent the markets into a tailspin. They had to reverse it soon after. In a short period of time, information has changed dramatically. The commodity market is telling you, oil market is telling you that we're heading into a recession. We are going to have a credit crunch in the US and globally. And so fixed income, commodities all tell you we're heading into a recession. Powell should pause, and we'll be cutting rates sooner than we think. And so that's a huge shift in psychology. It's got Bitcoin and Ethereum on the move. If there was ever a time to be in Bitcoin and crypto, this is why it was created, in that governments print too much money whenever the pain gets too great. And we're seeing that.
I get that to some degree. I also think that basically the bailouts by the United States helped stabilize things like the stable coin, which was pegged to the dollar, as you know, and you saw where crypto had fallen as a function of all of that. But I think the larger question right now is, are we in a I don't want to call it a game because it's not a game, but is this dominoes? Do you see the possibility of contagion in our banking system? Do you think it's limited to what's happened in Europe? Do you think what happened with SVB is enough?
Listen, there is contagion. People learn their lessons, and so we're going to move towards 4 or 5 big depository institutions unless the Fed goes one step further and de facto. I mean, they kind of did guarantee deposits ish, but they really didn't. And even the thought of, oh my God, my money could be tied up for a week, or my money could, why am I taking any risk? Like, that story is out there. It's hard to put it back in the box. And, maybe yesterday it felt like, well, maybe it'll get back in the box and another guy hits. And so I think that the Congress and the Fed is going to have to do something more dramatic on deposits, or we're going to see a constant pressure on these regional banks in the whole system, right? And so now you've got a market that's going to go into a credit crunch. How do banks rebuild capital? They lend less. And so you're going to see a credit crunch happening in the United States, and that's starting to get priced in the market in a dramatic way.
They are plunging. Melissa, good morning. Concerns about the banking system rekindled in the U.S. after, as you said, Credit Suisse shares plunging more than 20%. That pressures U.S. and global stocks, and that's really a furious flight to safety in the bond market. The chance, I just want to set the stage here, the chance of a 25 basis point hike is still relatively high at 67%. Versus 33%. But they deteriorate after that. If you look at the next thing, the January 24 Fed funds futures tells us where the market thinks the Fed will be at the end of the year. That's the one that's down 56 basis points this morning. I have to say, I don't think I've ever seen a plunge like this. It's quite remarkable. We were at 450 yesterday. Now we're down at 394 for the January 24. So there's an idea that the Fed would hike another quarter and then shave another 70 or 80 basis points off it. Even before the concerns about Europe were raised, Torsten Slok saying, quote, with the regional banks, that is in the U.S., playing a key role in U.S. credit extension, the Fed will not raise interest rates next week, and we have likely seen the peak in both short and long rates during this cycle, Melissa. So, and I did check this morning, the Federal Reserve does have essentially an existing swap line. It's now called a repo line. But basically, if the European Central Bank does want dollars, just clear, the Fed is not saying anything. This program had already previously been in place, but they do have an existing ability if the ECB, if there's a need for dollars to come to the Federal Reserve.
Welcome to the Crypto Teacher. And I come back with that video just to make you think.
Don't forget to like and subscribe to the channel.
And we have Mike Novogratz saying that we're going inside of a recession. But guys, we know we're going into a Great Depression caused by the Fed. Remember, they got to destroy this legacy market in order to give the fourth industrial revolution rise. And that's the reason why the Fed is not done raising rates. And that's the reason why the ECB is going to still raise the rates. And guys, what are they doing? They're shrinking liquidity, the credit crunch. And guys, we know that hits small banks, small businesses, and eventually is going to hit employees. Remember, your small businesses are the ones who fund America, not these corporations. And we have Mike Novogratz says a good time to get into Bitcoin and crypto. And guys, I'm not your financial advisor, not financial advice. Please do your own research. But once Janet Yellen and Congress get done with this debt ceiling, liquidity is going to shrink at a faster pace. And remember, the crypto teacher told you, and it's going to hit all assets. And we have Steve Leisman talks about a Fed repo line for Europe. Make sure you remember that and make sure you save this video because you're not going to hear about it anymore. But guys, we know these banking collapses were already seen down the road. So we know the Fed has already ran simulations. So that's the reason why they're bringing in safety blankets. They know what's going to happen. But let's listen to Steve Leisman say it again.
The Federal Reserve does have essentially an existing swap line. It's now called a repo line. But basically, if the European Central Bank does want dollars, just clear, the Fed is not saying anything. This program had already previously been in place, but they do have an existing ability if the ECB, if there's a need for dollars to come to the Federal Reserve.
Goldman Sachs, which had both advised SVB, Silicon Valley Bank, on its capital raise, happens to also have been on the other side of that transaction when the bank sold 21 some odd $billion at a $1.8 billion loss. SVB sold that to Goldman Sachs, and Goldman Sachs, it appears now, has collected at least $100 million as a fee for such service. Of course, this is going to raise all sorts of questions as people try to untangle what happened at SVB in the final days and what was going on. We've seen this before. By the way, Goldman Sachs, I should say, and all banks collect a fee when they do a mass block transaction like this. They're effectively taking $21 billion, putting it on their balance sheet, ostensibly some risk. In this case, by the way, not much risk because it was, mostly liquid and very highly rated government bonds. But the question is, if you're going to have a fee that's $100+ million, what should happen to that fee? We're having lots of conversations in Washington. By the way, bankruptcy judges look at clawbacks.
Why is it, though, if Goldman, they performed a job.
And
they got paid for the job.
They ship the product, right? They ship the product.
Why should any of it be clawed back?
Well, so and I'm not suggesting it will be. I'm just suggesting that
why is there even that sort of ethical dilemma as to whether it should or shouldn't? Why is that a question?
So historically, when companies have gone bankrupt, and by the way, we saw this even with FTX, right? There's question. Creditors immediately say, all the money in the final days we want clawed back. Now, by the way, a lot of judges say you can't claw that money back. That was a service that was provided. Right. But it has to be provided, and this is the important part, at a fair price, so it can't be a usury price. Okay. And it has to be considered arm's length. And this is where it gets slightly more complicated.
Arm's length is the complicated factor.
Arm's length is the complicated part because they were also playing the role of advisor on the capital raise. You could argue they were all one of a piece. Now, to try to protect themselves, Goldman Sachs said to SVB, from what I understand, look, if you're going to do this, you can hire another advisor on that particular part of the transaction.
And it chose not to?
And SVB chose not to.
All right.
So that may ultimately be the...
I think they're clean.
You think they're clean?
I think Goldman Sachs... that's based on the limited knowledge that I have.
I want to believe that all of this was done in good faith and that they tried their best. And I think there were a lot of factors. We talked about Moody's, gun to the head. Sure. Lots of things that were going on. But given all of the conversation around SVB and the recriminations, the DOJ, we've talked about the SEC investigating.
Throw this into.
The fee, I imagine, will be part of that discussion as well.
By the way, that bond portfolio that they bought, worth more today, thanks to what we're seeing this morning.
Worth more today than... By the way, you know who's going to make out like a bandit in the end? The U.S. government on the SVB collapse. Think about it. They got it for nothing. And think about what that portfolio looks like.
Well, what we're learning is that the Department of Justice and the SEC are both investigating the collapse of Silicon Valley Bank. NBC News reporting that information, but it's not yet clear how far along these investigations are and what, if anything, they're going to be focusing on. Two sources tell NBC one part of the DOJ investigation will examine the sale of stock by bank executives before the collapse, and a senior law enforcement official says the investigation is being led by a team of FBI agents out of the San Francisco field office who specialize in white-collar crime. Now, one issue at hand will be, did the executive sell based on non-public knowledge of the true condition of the bank and therefore reap any improper gains? That can always be difficult to prove, but there is a paper trail to start with here. Our own Robert Frank reported yesterday that Silicon Valley Bank CEO Greg Becker sold nearly $30 million in stock over the past 2 years, including $3.6 million on February 27th. That's just days before the bank disclosed a large loss that triggered the stock sell-off. Other executives at the bank, they've also sold millions in shares since 2021. The investigations are said to be at their early stages, and there's no indication yet that they've discovered anything improper so far. Andrew, back over to you.
And guys, you heard that correctly. Goldman Sachs, again, just like the housing crisis, is on both sides. Get $100 million fee. Guys, it should be legal. And then CNBC had the nerve to play the Hegelian dialectic. And we see that SVB was under the Fed watch. And we know the CEO and others were selling stocks when they knew that the bank's credit was going to be downgraded. Guys, Moody's is very important, but you're not going to hear it from mainstream media.
What you're about to watch is one big, huge lie. Take a look.
No losses will be, and this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund.
Who pays the fees? That would be the taxpayers. Another lie of Biden.
You say the federal government and Joe Biden nationalized the banking system with their move this week. Explain that.
Yes, it's exactly what happened. Well, think about it in very simple terms. It doesn't matter how good or bad of bank managers you are going forward. And let's take the case of Silicon Valley Bank. That was not the Fed's fault. That was not regulatory issues. It was just plain, straight, idiot management underneath an incompetent board. I hate to put it that way, but those are the facts. And so at the end of the day, you can't protect yourself against idiot management in any sector, including banking. There's always a black swan swimming around in the lake somewhere, and you found it in Silicon Valley Bank. But here's where we're at this morning with this new policy. I don't care what bank we're talking about anymore. You as a depositor have no risk whatsoever. So what stops the idiot bank manager going forward from doing anything they want within the regulatory environment, taking as much risk as possible to get the stock price of that bank up? That's how they're compensated. This is going to create some very perverse acts by bank managers and crazy behaviors. And in the end, it's not a long-term solution whatsoever, because either you decide to nationalize the banks, in which case all of bank managers work for taxpayers as employees, just like giant utilities, or you let the private sector be the private sector. And within that, you have collapses by idiot managers like the Silicon Valley Bank, which, by the way, at the end of the day would have only cost depositors around 5%. Those that were uninsured above $250,000. And frankly, the people that have money more than $250,000 are the sophisticated investors. They can take the hit. We shouldn't have done this, and now we have the moral jeopardy ahead of us of idiot bank managers everywhere doing crazy behavior
In there than $250,000. So you will be the beneficiary
Yes.
of this bailout, like every other depositor at SVB. However, the difference between you and probably everybody else is you're saying this bank should not be bailed out. Am I wrong on that?
No, you're not. This bank was run by idiots with an incompetent board. It's one bank. No one ever heard the name before. Now it's internationally famous.
Why the hell did you keep your money? Kevin, you're a smart guy. Why did you keep your money there if it was run by idiots?
No, it's one of many, many banks I keep my money in.
And guys, they had to put Kevin O'Leary behind the curtain for a while after the FTX situation. But now they bring him back on the stage, saying that Biden has nationalized the banking system. But guys, we know all these moves are for the fourth industrial revolution. Guys, just imagine the protocols, the technology that we have right now. XRP and XLM are able to free up trillions and trillions of dollars of liquidity. And guys, we're seeing all the central banks are running CBDC tests as we speak. So while the masses are distracted, the NWO is building. So we know Kevin O'Leary is doing nothing but playing the Hegelian dialectic.
The answer is absolutely not, for many reasons, outside the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in, whether it be by our regulator or the European regulator or the Swiss regulator, and we're not inclined to get into a new regulatory regime.
Continuing the conversation into the crisis now gripping everyone's attention here, the statement out of Swiss regulators just a little while ago, basically about the potential, if necessary, the key quote there, to provide liquidity backstop to Credit Suisse. Sally Bakewell joining us right now. She leads Bloomberg's U.S. finance coverage, here to talk, of course, about the second largest Swiss bank. But let's start on the broad strokes here, because we're talking about a statement by the main regulators over there in Switzerland saying that based on Basel requirements, Credit Suisse meets those minimum requirements, and if Credit Suisse needs the liquidity, they're there to provide it.
Yes, I think this comes amid a really bad sentiment for banking at the moment. Don't forget, we've had the collapse of 3 banks, and of course, while for completely different reasons and very sort of isolated and particular to those banks, the sentiment has probably taken a bit of a hit because of this. And Credit Suisse, it's been struggling for a long time. It's been hit by scandals, by leadership changes, by huge losses, and then exacerbating all of that just as it's trying to turn itself around. Its biggest shareholder says that it is not interested in increasing its stake.
So now the big question is, how big is the damage potentially from Credit Suisse continuing to go down this path of erosion? And you've been reporting, Bloomberg has been reporting, that a lot of the big U.S. banks have known about this and have been making moves to protect themselves.
Yeah, that's right. It's possibly a positive sign that some of the biggest banks like JP Morgan, Citi, and Bank of America, they've all kind of been whittling down their exposure, their direct exposure to Credit Suisse over recent months. We saw the shares plummet to a record low. We saw some of its bonds kind of signal almost distress levels. But again, it's sort of the big question of how much is sentiment and how much is really a key serious issue, given that we now know the SNB says it will provide a backstop if needed. So I think the next few hours and how the bank responds and what it comes out and says will be key. We already saw some headlines this morning with the CEO saying, their liquidity is strong and that the bank is still on solid ground.
Now, guys, we have Credit Suisse in trouble, and Saudi Arabia coming in saying they're not going to save them. And in the mainstream media, they're saying that people are betting that they're going to file bankruptcy. But guys, we know better. Look how old these banks are. And I forgot to put it in the first video. But guys, Credit Suisse is 167 years old. But the main reason why they ran into trouble, because remember, they're spinning off the U.S. assets. And then plus, we have the government coming in saying they're not going to have an issue. But guys, we know the NWO, the master magicians. And we know they love their dates. This is the Ides of March. But we do know, just like Julius Caesar fell, we're seeing the fall of America to Babylon with the United States world reserve currency and the rise of the emerging markets, the BRICS nations, led by China, the dragon, with that digital yuan backed by that digital SDR. And remember, the Cryptoteacher wrote about it a long time ago and told you a long time ago because he knew when it comes to the New World Order, it's all planned out. You have a wonderful day.
Going to a different economy. And we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
And so we'll import Chinese-based CBDC technology. So it's going to be CBDC in a box provided to you by the People's Bank of China.
Cryptoteacher and the New World Order book, plus the 3 kids books. It's time to re-educate. Also, new to cryptos, Coinbase, Bitrue, Binance. Do not forget book links and crypto links are in the description. The stock channel, guys. Don't forget to go like, subscribe, spread everywhere. You have your Kobo, your chip stocks, your banking, your gaming. While everybody's sitting at home, get on stocks, the Xrp, the biotech stocks. And while everybody's at home wishing they were still getting that free money, what are they doing? Drinking and smoking weed. Don't forget about those stocks, and you have a wonderful day. The most powerful person in the world is the storyteller. The storyteller sets the vision, values, and agenda of an entire generation to come. Steve Jobs. And guys, you know I truly believe in this. When you look at the New World Order, they're the storytellers. And that's the reason why I wrote my New World Order book. But guys, now it's time to change the current generation. And I wrote 3 kids books. You know, I love the Trinity because I understand the power that's in it. So I have 3 books. We have an opportunity to change the generation, to educate, not just me, but I want to show you that I take action on a daily basis. And I want you to take action on a daily basis. Whether it's your job, whether it's in your community, we have an opportunity right now to educate the masses. I posted this on my Twitter account. Please share, but this is a short clip of the 3 books. There's going to be a clothing line and action figures. Please get these books for your kids, nephews, cousins, friends, so therefore we can start the re-education now. Because as we see, the 4th Industrial Revolution foundation is definitely here. Robots, algorithms, drones, taking humanity out the picture. We have to re-educate. But let's get into the video.
Part 1. King Joshua and Grandma Tam save the village. Part 2. King Joshua and Grandma Tam save New York from COVID-33. Part 3. King Joshua and Grandma Tam goes to China.
It's mandatory to get part 1, part 2, and part 3 of this series. It's time to re-educate Generation Z.